I want to welcome you to the Baker Institute Energy Forum. This is becoming one of our most popular June events, and we thank BP for joining us. And also I'd like to thank our partners, the USAEE, for serving as a co-sponsor for today's event. It's a very interesting year to do the year in review because so many different things have happened since we last got together. And we're very interested to see, I always find with the BP Statistical Review, of course, it's a very important tool used by industry and the academic community and media, but it's always very interesting to look at trends and to look backwards when we've had such a dramatic swing in oil prices to try to think about, get away from the hysteria and get back down to the numbers, because I think the numbers are always very instructive. So I'm going to start in my new tradition, like you put me in front of a microphone and I can't resist myself from just throwing a few slides up about Baker Institute work. And unlike Mark, who's probably going to start looking very retrospectively, my slides are only looking forward. Ken Metlock, our other energy fellow, is not here today. He's out in California. Working on with the California Energy Commission on a special workshop they are having. So some of these slides reflect some of the modeling work we're doing here at the Baker Institute. Just to give you some roundup of what we have coming for the coming year. Our project, as many of you have already started being involved, the major theme this year is to look at the energy market consequences of the U.S. carbon management policy. We'll be having workshops to go along with our research. We'll be looking at the Renewable Portfolio Standard and what it means to make that a national standard. We're looking at the impact on natural gas markets and world LNG if the United States goes to some program that prices carbon. We also have another group looking at the impact of R&D spending on the possibility of cost breakthroughs in renewable energy. So it's going to be a really pretty interesting study. And we are also embarking on a new study looking at what future politics in Mexico might mean for reform in the energy sector in Mexico and how that might affect the United States energy security and global markets moving forward. So those are our two mega topics for the coming year. In line with the new administration, we're having a series in September on plug-in electric cars. I feel like everybody needs to get more informed on that, and we will be running a scenario in our new U.S. energy market study that advents plug-in electric cars into the system, and hopefully we can make some predictions about impacts on electricity demand and natural gas pricing and so forth, and competition points for fuels. But we are very excited to say we have our Shell Distinguished Lecture Series, and our first speaker for the fall will be Chris Payne, the director of Who Killed the Electric Car, which I think will be interesting and bring a lot of our students into the Baker Institute, since that's a generational, institutionally generational piece of documentary work. But we're also going to try to bring some people who look at battery science and hopefully get someone from the Obama administration to talk to us a little bit about their plans. So with that, let me start with my opening slide. Mark is going to show you some historical perspectives and probably some statistics that is going to make us all think about the cycle. And I wanted to communicate to you what I call some of the sort of myths of the industry. This year's myths. Last year I talked to you guys about the myths of what was holding the market up, and then of course they were myths and the price came down. So this year the question is, what do we know about out of a cycle, out of an up and down cycle, and will it happen this time? So the first thing that people tend to say is that it's different this time because the cost structure is so much higher. And so, one has to question whether or not, if we have a change in the cycle and the change in market economics and drivers, whether the cost structure might go back to a different kind of cost structure where it doesn't cost $80 a barrel to do tar sands. And I remind people that at the beginning of this cycle, Shell and some of the other companies were completing tar sand projects and operating them at $10 a barrel. So I try to remember people that, you know, Kiewit and some of these other operators are probably not going to have too many refineries to be building around the world, and so they're going to have spare capacity, so to speak, and some of that capacity could be put to work in places like the tar sands. Second myth, which is a very interesting one, which I myself was not 100% aware of until we went back and looked at it, which is that everyone in the market today assumes that demand growth is going to go back to exactly where it was before we had this whole up and down cycle, and that has not been historically true. So I try to frighten people by reminding them that we had a giant growth in demand in the industry through the 1960s and up into 1972, and that it was the same feeling that we had for the 90s and into the 2000s. But to give you a comparative idea, at that time, up until 1972, demand was rising 7.6% a year. And after the 73, 79 crises, we considered very high growth to be 2% a year. So I just sort of throw that out there as a frightening prospect that if we had some kind of shrinking of the demand growth rate this time, we're shrinking off at 2% and not 7.6%, and that's a pretty low number. The third thing that I see very clearly is that people assume that Saudi Arabia will go back to exactly the same policies as they've had, again, from 2003 to 2007. And I think a lot has changed in the Middle East, and there's going to be a different set of expectations now that we've had a boom and possibly bust cycle. People are now having a sort of a clearer understanding of what it meant to have that petrodollar inflow this time, and whether or not it was or wasn't spent well, I think is going to be now analyzed in a way. You hear some people in the Gulf who are in the elites talking about the fact that having a very high oil price doesn't make sense because the money can't be tapped fast enough. It winds up coming back here in a bubble asset. So whatever problems we all had with our pension fund, if you imagine to be Kuwait or Saudi Arabia or Abu Dhabi, they had the same problem. They put that money with money managers. They bought the same assets the rest of us bought, and they lost the same amount that the rest of us lost. So there's some deeper and more complex understanding of whether one can really tap the money, the rents that one would grab from a very high oil price. And then I hear it said very, very frequently in the industry that these green policies are nonsense, and that, you know, President Obama doesn't understand the oil industry, and John Holdren doesn't understand the oil industry, and therefore none of these policies will stick, and they will have no impact on oil demand moving forward. And I'm going to show you a few slides on why I think that's probably not the case. So one of the things that's very interesting about what's happened over the move up was that starting around 2004, people's perception of what we call the long oil price, in other words, I'm buying a 10-year derivative or a 5-year derivative, really increased. Prior to 2004, everybody in the market just assumed that if prices ever went up, they would eventually come back down to the mean, which was considered $18 to $20. So we've had this sort of structural change in the futures market, and the long oil price is starting to move down, or had moved down from 75 a little bit this year, but you know, we're still having this sort of difference of perception in the market about what's the long-term average price for oil. So the question is, you know, of the things that's changed, which is the shale plays, these giant finds off Brazil or the Eastern Mediterranean, and energy efficiency, you know, how much do those change over time people's perception of the stability of this $75 long oil price? Now, we have a demand model, and we looked at different scenarios for growth in the U.S., and as you can see, even under, you know, fairly pessimistic scenarios for the U.S., you really, you know, you get out to 2010, and we don't expect to see much of an increase in oil demand, even under a scenario where the U.S. economy would have grown by 0.5% in 2009, which doesn't look like it's going to happen. So our view is the demand trend for the United States market anyway is probably going to stay down for at least another year. And ExxonMobil, who we'll invite to present there, also they have a sort of a statistical forecast view, and we're going to have them come and present it. They've done some very interesting work on programming in these energy efficiency gains that are probably likely to come from this cycle. And they are projecting by 2030 it'll be over 180 million barrels of oil equivalent will be eliminated from the oil demand picture, which is pretty interesting when you see it on a bar graph. Now, we're all counting on China and India to save the market. And of course, that is, you know, besides the idea that speculators are moving into oil as a commodity as a hedge against inflation, which is probably really truly the driving feature putting the market up. You know, there is some fundamentals at play, and the Chinese were back out buying in the physical market, and the overhang of speculative cargoes was sort of being worked off the water. And so there's this thinking about, you know, China, and I won't linger on that because I'm sure Mark will linger on that. But Ken and I have this slide, and we've shown these all to you before, but I always like to ask the question, which is, if the Chinese are really going to replace the United States as the driver of the market, and you think about how many vehicles we have in the United States versus how many vehicles are on the road today in China, even at the fast pace they're adding them. Many people in this room are economists, and I can just simply sum this slide up by saying, how long will it be how long does the time horizon have to be before that blue line crosses that red line? And it's a pretty long horizon. The other thing that Ken did, which I thought was a very clever idea, is that the Chinese economy is moving away from subsidized prices and moving to a much more global impact in terms of oil prices going up and down and their impact on the Chinese economy than what we've seen in the past. And so Ken did a little exercise where he took the changes that happened in the United States post-79 in terms of squeezing oil out of parts of the industrial sector and residential sectors and bringing energy efficiency into China, because if you think about it, it's not a very efficient industrial sector. And if, as they move forward and have to respond to global prices, they would get the same kinds of changes that we had in the United States, then some of this really big bullish optimism that people have about Chinese oil demand rising by 7 or 8 million barrels a day, you know, out over the next 20 years starts to dissipate if they start to make the same kinds of changes that happen here in the United States. And if we took it exactly what happened here in the United States and apply that to the Chinese economy, it shaves about 4.5 million barrels a day off of the growth that would be expected from China. So kind of an interesting statistic. And then if you were to combine that with President Obama really actually putting in place the 50 mile per gallon CAFE standard by 2025, which would shave something like 6 or 7 million barrels a day from US oil demand, you start to get a little less optimistic that this new $75 or $80 long oil price is the justified oil price because of the giant growth in oil demand that's expected to come over the next 2 decades. So with that, I just leave that open as a question for everybody's mind when we do the retrospective and think about where we've come from. Let me just reintroduce Mark Finley to those of you who have not heard him speak. He is a fantastic presenter of the BP Statistical Review. He now serves as the General Manager for Global Energy Markets for BP America in Washington, D.C. And he's responsible for BP's coverage of the global energy markets. He's been on the BP economics team in London and Washington and has been in the industry and working either as an energy economist in the industry or for the U.S. government for over 20 years. So brings a wealth of experience to the process, and it's my great pleasure to introduce Mark.
Thank you very much, Amy, for the introduction, Ambassador Jaragian and the Baker Institute for hosting, and to the local chapter of the U.S. Association for Energy Economics for co-hosting as well. And thank you to each of you for taking time out of your busy days to join us for this discussion. Amy's given a bit of introduction on the statistical review, and many of you are familiar with the publication. For 58 years now, BP has published a statistical review of world energy, and the objective has always been the same, and that is to provide timely, objective energy market perspective. It's the first publication that comes out anywhere in the world that gives a comprehensive view of what happened in the world of energy last year. And as Amy notes, it is an objective, factual, backward, a document of historical data. But of course, the whole point of interrogating the historical data is to shed perspective on today's energy situation and to inform our thinking about the future. Now, the data that's in the printed book goes back 11 years so that we can show 10 years worth of growth rates. Many of you know, but just in case, on our website we have much more data available, including data sets going back in many cases to the mid-1960s, as well as information that's not in the printed book on renewable forms of energy. All of that will be wrapped into the presentation. And what we seek to do in this presentation is to take all of those tens of thousands of data points and distill out of them a story of what's been going on in the world of energy through 2008, and where we have the data to discuss what's happened so far in 2009 as well. It was an extraordinary year, 2008. It was a year of high volatility, not just in energy markets, but in the economic headlines as well. It saw the beginnings of what has turned out to be the deepest world recession since the Great Depression. And energy market developments were profoundly impacted by the trajectory of the economy, as we will see shortly. There was another big event that happened in 2008, and that is that, for the first time ever, energy demand outside the OECD accounted for the majority of the world's total energy demand. We'll use the reference to OECD a lot. It stands for the Organization for Economic Cooperation and Development. It is basically the club of mature market economies in North America, Western Europe, and bits of the Asia Pacific. Countries outside of that club, the emerging economies of the world, last year for the first time ever accounted for the majority of the world's energy consumption. And while this has been happening and building over many years, it signals a dramatic change in the center of gravity in world energy markets. And we'll look into that theme as well. And of course, in the face of all of these profound changes in energy markets and this tremendous uncertainty, it raises some important questions and doubts about our energy system. Can we sustain high economic growth, and can we produce the energy needed to sustain economic growth? Can energy markets deliver enough investment to sustain the secure development of energy? Or do governments need to intervene more forcefully going forward? Or is there flat out enough energy and enough ability to bring this energy forward to grow the economy in the future? Now again, as Amy mentioned, this is not an essay in predictions. It's about examining the factual historical data to shed light and perspective on all of the questions that we're grappling with today. So with that, why don't we jump in? First, to the economy, and many of you know this story. What this chart shows on the left-hand side is the growth over the last few years in the world's economy and in changes in world trade. Last year, the world's economy grew by 2%, the first below-average year in 5 years, and that's an important point. For those of you who suffered through this presentation last year, you recall that we had said that the world had just finished the strongest 5-year stretch of world economic growth in a generation. In fact, the only time the world has seen a stronger stretch of 5-year economic growth was the 5 years that ended with the first oil price shock. So right there is a clue about what this relationship is and where we're going with this. We can also see a dramatic slowdown in trade, and this reveals one of the other important dimensions of this economic downturn, which is that while it was made in America, it spread very rapidly around the world. Transmission mechanisms will be debated by economists for decades, I'm sure, but it seems to have something to do with both the collapse of credit markets as well as the very rapid collapse of world trade. And in fact, if you look around the world, the countries that have been most deeply affected by the economic downturn are the world's exporters, not the country where it started. I think another important dimension of this is that where we go from here. We've seen that basically to sustain continued economic growth, the U.S. and many other countries around the world have replaced consumer spending that was financed by borrowing with government deficit spending that's being financed by borrowing. Either way, I think it's unsustainable at its core, and it has I think it means that there will be real constraints on economic growth going forward. And what it says to me is that we're unlikely to very rapidly get back to this period of extraordinary economic growth that we had seen before last year. Now, all of this had profound implications for energy markets. This chart shows prices over the last couple of years for coal, natural gas, and oil, all indexed to a common starting point so that we can compare them with each other. And the message is the same. Everything went up when the world's economy was growing and fell precipitously when the world's economy entered into a contraction in the middle of last year. In fact, from their peak in July to the end of the year, crude oil prices fell by about 75%. Natural gas and coal prices each fell by about 60%. Now you can see that there have been different trajectories so far this year, with gas prices continuing to weaken, oil prices actually rebounding and in fact doubling from their bottom, as Amy mentioned. We'll get into that. Behind all of this, there was a very significant, pronounced slowdown in global energy consumption last year. Worldwide, primary energy consumption grew by 1.4%. That was the weakest performance since the last global recession in the early part of this decade. Coal had the slowest growth since 2002 worldwide. Natural gas had the weakest year since 2001. And worldwide oil consumption contracted for the first time since 1993. And as you can see, in energy markets, as it was in the economy, it really was a year with two halves, correlated around the economic story. But of course, each fuel has its own detail, and we'll get into that shortly. I had mentioned earlier that last year, for the first time ever, the emerging economies of the world accounted for the majority of the world's energy consumption. The progression of that on a 10-year increment is shown on the chart in the upper left-hand corner here, and you can see how rapidly the non-OECD countries have been growing relative to the OECD. It's also, we break out fuel by fuel to show how this has developed on a more granular detail. Last year, also for the first time ever, natural gas consumption outside the OECD surpassed that of the OECD. Of course, coal consumption has been dominated by the emerging economies of the world for 20 years now. Oil is still dominated by the OECD countries, but again, the role of the non-OECD countries is rising rapidly. They account for about 45% of total energy, total oil consumption now. Another way to think about the relationship between what's happening in the world of energy is to examine the relationships between energy consumption and economic growth. And we show that chart here, again, breaking out the OECD countries and the emerging economies of the non-OECD. Now, energy at its heart is always fundamentally driven by economic activity. We can see that relationship, broadly holds outside the OECD, a bit perhaps of a price impact in the sense that economic growth remained high and we saw a bit of a moderation in energy consumption growth. But overall, actually the performance last year was broadly in line with the historical relationship between economic growth and energy consumption. But look in the OECD, something else is happening here. Last year, we saw a very sharp decline, almost 1.5% in overall OECD energy consumption. Note that the economy, while it slowed dramatically, was still growing. Also, if we look back over the last 3 years, we can see that this relationship between economic activity and energy consumption is really broken down. Well before, by the way, anybody was talking about a recession taking place. What can we conclude from this? Well, to me, the obvious thing that's missing on this chart is the impact of prices and higher and rising prices. And I think many of us have bounced this idea around over the last few years, but I think the data is very clear that the countries where we see very clearly an impact of higher energy prices is the OECD countries, and that makes sense. But there's a reason why these are called the market economies of the world, after all, because these are the economies where price changes move through to consumers and producers alike have more flexibility to respond to those changes. By the way, let me note that almost all of this decline last year in OECD energy consumption came from one fuel in one country, and that is oil consumption in the United States. And again, we'll come back to that idea. Now, having looked at all of this at a very high level, I think the way to really get beneath the surface of it is to examine developments fuel by fuel. So let's turn there next. The first fuel we'll cover is oil, and there's a reason for that. Oil is still the dominant fuel in the world. Even though it's been losing market share and consumption declined last year, oil still accounts for 38% of the world's primary energy consumption. This chart shows what you all well know. It's the price of oil going back to earlier this decade. The price of oil now, on an annual average basis, has increased for 7 years in a row. By the way, that's something that's never happened before in our industry, going back 150 years. In fact, since Colonel Drake drilled his well 150 years ago this summer in Titusville, Pennsylvania. Within the year, we saw unprecedented oil price volatility. Prices began the year around $100 per barrel. By early July, prices were exceeding $145 a barrel here in the US. And who would have thought at that point that within 6 months, by the end of the year, the price of oil would be $35 a barrel. And of course, as we've mentioned already, and as you well know, oil prices have also doubled since that trough over the last 6 months. So what's driving this? Now, it's not surprising, I'm sure, to all of you that as an economist, I'm going to proceed to walk you through the supply and demand fundamentals. Actually, only the demand and supply fundamentals, because we'll come to demand first. Worldwide, oil consumption last year fell by about 400,000 barrels per day, 0.6%. It was the first decline since 1993, and the biggest decline since 1982, so the biggest decline in more than 25 years. The chart on the left shows that that decline occurred exclusively in the OECD countries, driven most importantly by a decline in the United States. U.S. oil consumption last year fell by 1.3 million barrels per day, 6.4%. It was the biggest decline since 1980. Meanwhile, oil consumption outside the OECD continued to rise, although the growth rate moderated last year there as well. Now again, we can break out this in a bit more detail by looking at what happened within the year, at least within the OECD where we have good data. And what we can see is that in the early part of the year, those parts of the barrel that depend on the economy, diesel fuel, jet fuel, were still growing. And what was declining early in the year was gasoline consumption. Again, gasoline consumption is driven primarily by changes in prices at the pump and the way consumers react to that, whereas diesel fuel is more driven by how the economy overall is doing. We can see that pattern held until the third quarter, when economic activity really came to a screeching halt. And you see a very rapid decline not only in gasoline consumption, but we see that diesel fuel and jet fuel switched from growth into a rapid contraction as well. To get a feel for how abrupt and how rapid this contraction was, I think a good example is to look at U.S. oil consumption in the month of September alone. And remember that September was the month when Lehman went bankrupt, financial markets seized up, and economic activity really did stop almost overnight. Compounded by the impacts of Hurricane Ike, in September of last year, U.S. oil consumption declined in a volume that is equivalent to all of the consumption of India. U.S. oil consumption in September of last year fell by India, which I think is amazing. That's a decline of about 15%. We can also dig deeper into consumption by slicing and dicing the data in different ways. The chart on the left-hand side breaks out the growth of oil consumption and compares changes last year with the historical average based on whether countries are importers or exporters. And as you can see, the only part of the complex that had oil consumption growth that was above average last year was among the exporters themselves. That makes total sense. If the price of oil is $100 a barrel, you would expect that the economies of the exporting countries would be booming, and they were, and oil demand showed the evidence of that. Everywhere else around the world, importers in the developing world and in the OECD saw that their oil consumption was below average. And again, that makes perfect sense. Another way to think, oh, by the way, this dynamic exactly characterizes the way the oil market has looked for most of this decade. So the experience last year in this sense is not unusual. Similarly, if we look at countries' oil consumption based on whether countries subsidize consumption or not, we can see that last year, subsidizing countries accounted for all of the growth in oil consumption, and all of the net decline came out of countries where oil is taxed to some degree. And again, this has been the case for at least the last 5 years as well. And this sheds important light on fundamental drivers of oil consumption growth. In addition to economic activity, it's the degree of subsidization. Now, to really understand the market, of course, we need to put supply and demand together. We'll begin to do that with this chart, which starts out with OPEC production. Now, let's rewind the clock back a bit and recall that in 2007, OPEC members reduced their crude oil production by about 1 million barrels a day. And that set the stage for tighter inventories and higher prices. As we began this past year, 2008, prices were already on a rising trajectory, and OPEC had already begun to unwind those production cuts. So we came into the year with OPEC production rising year on year by about 1 million barrels a day. Prices continued to rise over the course of the first half of the year. Saudi Arabia, as prices accelerated in the springtime, twice in May and June announced unilateral production increases. And the market's response to each announcement was for prices to continue rising. Now, we tend to focus on changes in oil production and how quickly it arrives in consuming countries, and we look at shipping times. Our research suggests that's really an oversimplification, because by the time you ship it, refine it, distribute it, historical evidence suggests that it takes really a good 5 to 6 months for the oil market to really fully digest big changes in production. So, OPEC raised production here. Just as those changes were starting to get digested by the system, 5, 6 months later, in the middle of the year, is exactly when the economy went into recession. So all of this oil supply hits the system just in time for demand to go away. Again, we can see that explained on the right-hand side, where we look at changes in world oil production and compare them on a quarterly basis with changes in consumption. And we can see that as consumption began to fall away, the reaction among the producers among OPEC was lagged. And in fact, on a quarterly basis, we still haven't seen worldwide oil production catch up to the massive declines that we've seen in consumption. Now, OPEC has been reacting. In fact, OPEC announced successive production cuts in September, October, and December. Announced cuts totaled more than 4 million barrels per day, and the actual delivered volumes of cuts have been about 3 million barrels a day. That's a relatively solid level of compliance, and I do think that it has helped to put a line under prices earlier this year and to support the rapid increase in prices we've seen this year. The anticipation that these cuts will eventually result in production cuts catching the weakness in demand. Elsewhere, production outside of OPEC last year declined by 600,000 barrels per day. In fact, that was the biggest decline since 1992. We'll come back to the question of why isn't non-OPEC supply responding to higher prices in a few slides. For now, let me note that almost all of, in fact, more than all of the decline was accounted for by the OECD countries themselves. These are the mature producers in the world: Mexico, the United States, the North Sea, and that is where the decline has been concentrated. It's also important to note that last year saw the first decline in a decade in Russian production, in the face of an increasingly hostile investment regime and a fall-off in drilling activity. And very predictably, 6 months after the drilling activity fell off, we saw the impact on the production side. But overall, we're looking at, outside of OPEC, a combination of field maturity, high costs, project delays, at least in the first half of the year, and increasingly constrained access in terms of investment regimes, has meant that overall non-OPEC supply has continued to struggle in responding to higher prices. And as I said, we'll come back to that theme very shortly. When we add it all together, the chart on the left here shows net changes in world oil production broken out again by OPEC and non-OPEC. And within OPEC, we break out crude oil and other crude oil among the countries that are within the quota regime and other forms of liquid production. What we can see at the bottom line, at the end of the day, the way to read this chart is that in 2007, worldwide oil supply fell and demand rose. Well, that certainly sounds to me like a recipe for higher prices. In 2008, supply rose and demand fell. Well, that, again, sounds to me like a recipe for lower prices. And that's pretty much what happened. as inventories, as we can see here on the chart on the right, we're looking here at the historical range of inventories and what happened to inventories last year and so far this year. Inventories rose very strongly, especially in the second half of last year. By the end of the year, inventories for the year as a whole had risen by 134 million barrels. That's the biggest decline in the OECD database, which has data going back to 1984. And of course, so far this year, inventories have continued to increase. By the way, it's important to note that as OPEC has been cutting production recently, OPEC's spare capacity, of course, is increasing as well. Now again, let me back up again and turn to this question of why are we not seeing a supply response? And I think the data in the statistical review can help us in this regard. We'll start by looking at the 1980. And that's actually a good place to start because 1980, like today, came at the end of 7 years of high prices. Back then, prices had gone from about $3 a barrel in 1973 to $37 a barrel by 1980. If you adjust for inflation, by the way, that means in today's dollars, prices rose from about $16 a barrel to about $100 a barrel. That is to say, almost exactly what prices averaged last year. Back then, by 1980, oil demand had begun to respond around the world for a variety of reasons. Oil demand over the succeeding 5 years, from 80 to 85, fell by 5 million barrels a day. Soviet Union production over that interval was about flat. OPEC was furiously cutting production, in fact, cut production by more than 10 million barrels a day to try to keep up with falling demand and this dynamic, rapidly rising non-OPEC supply. Soviet Union and many OPEC members at that time were basically off limits for private investment. So we'll concentrate our analysis on what was happening in the non-OPEC countries. I mentioned earlier that over 5 years, production rose by 5 million barrels a day. Almost all of that increase, 80% of it, came from 14 countries with a collective reserves to production ratio of 31 years. If we look at all the other non-OPEC countries, there was basically very little supply response, including in big producers like the United States, Canada, China. In those countries, there was a collective reserves to production ratio of less than 12 years. So again, the lesson is not surprising. To have a price response or to have a supply response to higher prices, you need a resource base that will permit the investment or permit the supply to grow, but you also need the investment to take place. You need an investment regime that permits the development of those resources. So let's fast forward to today's reserves distribution. And again, we're looking at reserves to production ratios here, and we've color-coded it to make it easy to see the message, which is that where are the reserves today that would permit a response to higher prices if the investment were to take place? OPEC. In fact, other than Kazakhstan, the only non-OPEC members the only non-OPEC countries that today have a reserves to production ratio of at least 30 years are 3 relatively small producers, Gabon, Sudan, and Vietnam. Now, this misses a potentially important development, which is new discoveries or technological innovations that open up new provinces. So, for example, this largely doesn't count the Canadian oil sands. We do have a portion of Canada's oil sands in our proved reserves, but not the full 160 billion barrels that's recorded as established reserve by the Albertan government. It also doesn't count the emerging Brazilian subsalt play because those reserves haven't yet been proved. So there is a potential for new developments to change this distribution of proved reserves around the world. But taking it as given, what it says is that these are the countries that need to invest to grow production in the face of higher prices. And the question is, will that take place? Now, for those of you who have suffered through these presentations before, you know that BP strongly has the view that the world is not resource constrained. This chart shows our distribution of global proved oil reserves, and the data is very clear. Proved reserves go up and not down over time. The world consistently has a pattern of either discovering new oil or increasing recovery rates at existing plays to replace every barrel of oil that is produced. The issue, rather, is the distribution of these resources. 76% of the proved reserves are in OPEC countries. Another 10% are in the former Soviet Union. And again, so the question is, will these, the countries that control these resources permit the investment to take place? And I think the record, at least recently, shows that countries like OPEC and many other countries act not only as a production cartel, but also controlling the pace of investment as well. And I think that's been an important dimension of how we've gotten to where we are today, and an important consideration for where the market goes in the future. Let me note, by the way, that today's proved oil reserves are sufficient to cover 40 years of current production. The number's been above 40 for a decade. For natural gas, that figure is 60 years, and for coal, it's over 120 years. Let's turn next to the refining industry. This chart on the left-hand side shows refining margins. And last year, refining margins fell, but still were above average for a 5th consecutive year. It was really, again, a case of a year with two parts to it. In the first half of the year, refining margins were very strong. Recall that gasoline demand was falling, even in the first half of the year, but diesel demand was growing. That imbalance created tremendous pressures on the refining sector and resulted in all-time record cracks for the production of middle distillates. By the way, middle distillates have been the fastest growing segment of world oil demand for 8 of the last 10 years now. We saw not only wide cracks for production of middle distillates, but also wide crude quality differentials. For example, here in the United States, in the Gulf of Mexico, WTI traded at an all-time record premium to Maya in the Gulf, $23 a barrel in May. But again, this didn't last very long. As soon as the worldwide oil demand began to decline in the second half of the year, refining margins contracted sharply, and we saw the emergence of a significant growth of spare capacity. Now, spare capacity is growing in the refining industry now for 2 reasons. Reason number 1 is that people have been building new refineries around the world, not necessarily here in the US, but again, it's a global market, so that really doesn't matter. China, India, Middle East, all growing refining capacity very rapidly. In fact, the growth of refining capacity has outpaced demand for 3 years in a row. And this is because barriers to entry around the world are pretty low, and investors were responding to 5 years in a row of very high refining margins. However, that growth of spare capacity was exacerbated last year because of run cuts as well. Now, this year we're looking at another record addition, or some of the strongest additions to refining capacity around the world in a generation. And worldwide refining capacity utilization has fallen sharply. In April of this year, it was 80%, which was the weakest for 10 years. And despite run cuts, refined product inventories have been at nearly 20-year highs. So again, illustrating the scope of the challenge that OPEC members face in trying to rebalance this market in the face of very weak demand fundamentals. Let's turn next to natural gas. As you can see on this chart, natural gas prices followed a very familiar pattern, rising to the middle of the year and then falling. A slight wrinkle here, prices in Europe and for Japanese LNG tend to be indexed to oil prices but with a 6-month lag. So basically, they began to fall 6 months after the rest of the energy complex did, but have been following it down, again, with that lag in recent months. Natural gas prices reached all-time record highs across all of these different contracts and markets last year, but then they fell very sharply. Worldwide, gas production grew by 3.8%. The biggest single increment to world gas production growth last year was right here in the United States. We'll come back to that. But there was also very strong growth in the Middle East and the former Soviet Union. The total increment to global gas production growth last year was the second strongest in our data set, which goes back to 1970. Meanwhile, gas consumption increased also, but by 2.5% worldwide. Growth was much stronger in the first half of the year, where we have data to demonstrate that, but fell off sharply in the second half of the year. For the year as a whole, the 2.5% growth was slightly below average. But gas was actually relatively a success story compared to other fuels that we track. Gas was the only fuel for which demand growth accelerated outside the OECD. That was driven, by the way, by China, which showed the biggest increment to oil or gas consumption growth in the world last year, and accounted for about 15% of the growth. Now, I've mentioned already that last year also, for the first time ever, consumption in the non-OECD countries exceeded that of the OECD countries for natural gas. Now, within gas, there's two stories I'd like to highlight. One is the spectacular growth of U.S. domestic production, and the other is the increasing ongoing linkage of regional markets through an increasingly large and flexible trade of liquefied natural gas. So first, to the United States, and I'm sure many of you know this story very well. U.S. natural gas production last year grew by 7.5%, 10 times the historical average, and in fact, in volume terms, it was the biggest growth ever recorded for domestic gas production. What's really interesting is that U.S. had the biggest increment to gas production in the world. The biggest decline in the world was right next door in Canada. Now, how can that be? This is the most integrated gas market in the world. It's essentially the same economy, responding largely to the same prices, very integrated markets throughout the supply chain. How is it that Canadian production had the biggest decline in the world and the U.S. had the biggest growth? And the answer is right here. The rapid development of unconventional gas production in the United States, coal bed methane, tight gas, and more recently, especially the shale play, has resulted in very strong growth of U.S. supply. 15 years ago, or in 1990, these unconventional supplies accounted for only 15% of U.S. gas supply. Last year, it was 50%. In fact, it's not fair to call something that's half of the total production unconventional. I mean, maybe my dictionary is wrong, but that doesn't sound like it's unconventional to me. Because of this very rapid growth, U.S. Henry Hub prices were some of the weakest in the world and have remained so this year. Also, natural gas traded at an all-time record discount to crude oil. So again, relative to other fuels, gas also, it wasn't weak only in absolute terms, but relative to other fuels as well. And we'll see examples coming up of how gas began to compete and take market share away from coal around the world. This is also a good point to stop for a second and consider what we mean when we talk about proved reserves. You know, it's important to remember that proved reserves are not purely a geological question, but rather there's an economic dimension of a proved reserve in terms of, you know, can the resource that's in the ground be developed, you know, in commercial terms. The technological innovations that have taken place in the U.S. gas industry over the past decade in terms of you know, hydraulic fracturing fluids and directional drilling have really been the key to unlocking this resource and, you know, and opening up the commercial development of gas resources that we've long known were there but couldn't figure out how to develop commercially. On the back of that innovation, the U.S. natural gas proved reserves have grown by 45% in the last decade. And that sets the stage for continued growth in this. By the way, on the right-hand side, we show that the other key to the development of these plays has been the ability to increase per rig productivity, which you can see looking at the rig count versus total production. By the way, I should also note that in the face of the collapse of gas prices over the last year, the rig count has fallen by more than half. In fact, there's no precedent in the Baker Hughes weekly rig data for how rapid and how steep the decline in the U.S. rig count has been. This will inevitably show up in production, of course, with the usual lags. Let's turn next to gas trade. Worldwide traded natural gas accounts for about 26% of the world's gas production and consumption. That, by the way, compares to about 2/3 of the world's oil, which crosses an international boundary. Most of the gas that's traded internationally is pipeline gas. 7% of the world's gas is traded in the form of liquefied natural gas. The reason why we're going to focus on that is because that is the portion that is beginning to establish linkages between what had previously been disconnected regional gas markets around the world. Now, the main vehicle we're going to focus on here is Atlantic Basin liquefied natural gas and the growing flexibility of it. The system not only continues to grow, but also to become more flexible. Partly this is driven by more capacity. Last year, the fleet of liquefied natural gas tankers and the capacity of those tankers grew by 19%. Meanwhile, liquefied natural gas trade overall was broadly flat last year. It didn't grow strongly for the first time in a long time, mainly because of production delays and technical difficulties at some existing plants. But what gas that was produced last year demonstrated increasing flexibility. In the year 2000, zero Asian LNG consumption came from the Atlantic Basin. Last year, in the face of robust demand in Asia, weakness in the Atlantic Basin, 12% of Asia's LNG receipts came all the way around from the Atlantic Basin. And again, this is a dynamic with which I think many of you are familiar. In Asia, at least in the first half of the year, demand was very strong. In Japan, the largest nuclear power plant had remained shut down for most of the year following an earthquake in 2007. That necessitated increases of gas imports to keep the lights on. We saw a very strong demand and a very strong pull from Asia, especially in the first half of the year, for Atlantic LNG cargoes. Meanwhile, here in the U.S., demand was weak. Supply was seeing an all-time record increase. We didn't need the LNG, and so U.S. LNG receipts last year fell by half. That began to reverse late in the year, though. As the recession really gathered strength, Asian demand weakened. You can see that so far this year, year-on-year, Asian receipts of Atlantic Basin LNG have been declining. Overall, LNG demand in Asia has fallen sharply along with industrial activity and power demand. And the result is that there is now increasingly a large volume of LNG supply that is looking for a good home. And as many of you well know, there are concerns that this surplus capacity could pose an additional threat to the U.S. gas market over the next 6 months. Let's turn next to coal. Now, at a global aggregate, first again, look at the coal prices. I should just start changing oil, gas, and coal in the labels on these charts because it's essentially the same price. Rise strongly until July, fall sharply thereafter. In fact, coal prices were even more volatile than oil prices on the way up and on the way down. And by the way, I'm not aware of anybody talking about speculation driving coal prices. Worldwide, coal has been the fastest growing fuel in the world for 6 years in a row. And that remained the case last year. Worldwide coal consumption grew by 3.1%, but that masks some very significant changes. We've seen, for example, in China, the coal story worldwide is always primarily a China story. China consumes 43% of the world's coal. 70% of China's domestic energy mix is met by coal. Last year, coal consumption in China grew by about 6.5%. That was actually the weakest growth in 5 years, and the growth rate of Chinese coal has decelerated every year for 5 years in a row. And yet, China still saw a growth in coal consumption sufficient to account for 85% of all of the growth in global coal consumption. In fact, if we take China and India aside, everywhere else in the world, coal consumption actually fell last year. And we'll see some examples of how coal has been losing market share. In fact, let's turn to that now. This happened in the European Union as well as here in the United States, by the way, but the example I want to show is the EU. In addition to what, at least in the first part of the year, were relatively high coal prices and weak gas prices, remember that there's also a European Union emissions trading scheme putting a price on CO2. That provided a further advantage for natural gas. And the result was that the EU last year saw overall coal consumption fall by 5.5%, the biggest decline in a decade. And this chart shows the example of just country after country where coal use declined and gas use increased. To put some numbers around it, in power generation last year, in the UK, coal consumption fell by 8% and gas use in power generation grew by 9%. In Germany, coal use fell by 6.5% and gas-fired power generation grew by 9%. Now, there's also a trade dimension to coal. The question is, if coal use was so weak, why were coal prices so high? Part of the story is that because of shipping constraints and strong demand in Asia, producers who sat on the Pacific Rim found it more advantageous to ship coal into the Pacific Basin rather than into Europe. So Europe lost about 14 tons of coal supply that it had been importing on the back of this dynamic. Even though coal consumption was declining, that decline was bigger than the decline in coal consumption, and what it meant was that European prices had to spike to the degree to incentivize pulling over some coal supplies from the United States to maintain a market balance. So again, we see examples where coal markets around the world adjust to regional price differentials. We see examples where coal and gas in particular compete against one another for market share. By the way, I should note that this dynamic of coal losing market share to gas has reversed now. Remember, coal prices also fell sharper than other fuels. As we'll see shortly, CO2 prices have fallen along with the recession as well, and the result is that this dynamic has reversed in the early part of this year. Meanwhile, against that backdrop, coal at the big global level is still driven by developments outside the OECD and in particular in China. Let's turn next to renewable forms of energy. Now here the story is very different. Renewable energy, unlike every other form of energy, is driven by developments inside the OECD. And that's easy to explain. These are the rich countries that can afford the subsidies that are needed to make these fuels competitive. Last year, worldwide ethanol production grew by 31%. That was the fourth year in a row that the growth rate accelerated. 60% of the growth in worldwide ethanol came right here in the United States. But even here, we see the impact of the recession and of lower energy prices hitting the industry. By the end of last year, with the combination of the recession and the credit crunch and also lower oil and prices squeezing ethanol margins, we've seen 15% of the U.S. ethanol production is now idle, or at least was so at the end of last year. Worldwide ethanol production is now equivalent to only 0.9% of the world's oil consumption. And again, this is on an energy equivalent basis. Similar story for wind and for solar generation capacity. Again, this data, by the way, is available on the website for the Statistical Review. It's not in the printed book. Note the color coding, and again, almost all of the growth in capacity around the world is in the OECD countries. One new wrinkle, China, actually saw its wind capacity more than double last year as well. Again, this is, I think, an emerging part of a strategy to diversify energy supply as well. But more broadly, wind capacity worldwide grew by 30%. Solar generating capacity grew by 70%. Both of those are accelerating rapidly. Although, so far this year, there are indications that, again, the credit crunch and the recession are affecting growth rates here as well. Worldwide, all of the wind, solar, and geothermal energy combined produce about 1.5% of the world's electricity. So while these fuels are growing very rapidly, they're growing from a very small base. And they're beginning to have an impact in the world's energy mix, but it'll be a long time, decades before these fuels are at the scale of the fossil energy economy that we're looking at today. Now, all of the energy consumption data that we've shown today has implications for CO2 emissions. Caveat, the CO2 emissions data that we're presenting here is based only on the oil, gas, and coal consumption data in the review. It's not official data, it's not audited, doesn't include non-energy sources of CO2 emissions or carbon that's sequestered